How to use an HSA to fund long-term care insurance. Do you have a health savings account? Did you know you can use it to pay long-term care insurance premiums? An HSA is a valuable tool tied to a high-deductible health insurance plan that can help pay for qualified healthcare expenses. You get a deduction on your contributions and your benefits grow tax-deferred. Plus, the distribution is tax-free if used for medical expenses. That's a triple threat. Since long-term care insurance premiums are considered a medical expense, you can use your HSA to pay your premiums. You can even use an HRA or MSA to fund your premiums, but not an FSA. To qualify for a tax-free HSA withdrawal, your long-term care insurance policy must be considered tax qualified. A tax-qualified long-term care insurance policy must follow guidelines that are in the Internal Revenue Code 7702B. Tax-qualified means your policy must be guaranteed renewable, it can only pay for long-term care expenses, and it can't have any cash value. Generally, traditional long-term care insurance policies are tax-qualified. Carriers such as Mutual of Omaha, NGL, and Thrivent all have traditional tax-qualified policies. Historically, hybrid policies were not structured properly to allow you to use your HSA to fund your long-term care premiums. However, now there are hybrid policies that are structured properly so that you can take advantages of your HSA. Some of the more popular hybrid policies today are Nationwide Care Matters 2, One America's Asset Care, and Securian Secure Care. These hybrid policies are structured so that the life and long-term care premiums are separated. Since the premiums are separately identifiable, they meet the definition of tax qualified in IRC 7702B, and you can withdraw money tax-free from your HSA to pay the long-term care premium, but not the life premium. How much can I withdraw tax-free from my HSA to pay my long-term care premiums? You can take a tax-free HSA withdrawal to pay long-term care insurance premiums, but only on your eligible age-based limit. The age-based limits in 2021 are 40 and under, $450, 41 to 50, $850, 51 to 60, $1,690, 61 to 70, $4,520, and 71 and older, $5,640. If you have check writing capability from your HSA, you can write the check directly to the insurance company up to the eligible age-based limit, or you can reimburse yourself from your HSA up to the eligible age-based limit. You can also use your HSA to pay premiums for your spouse and current tax dependents. Your premium deductions may not be significant early on in your policy because the limits are lower. As you get older, it becomes even more beneficial since the deductible limits increase. For seniors whose income decreases in retirement and medical expenses increase, this is very helpful. The bottom line is if you have an HSA, they are valuable resources that you can use to fund your long-term care insurance premiums through the tax-free withdrawals. I'm Kelly Augsperger, certified long-term care insurance specialist with Steadfast Insurance. If you have any questions or want to learn more, connect with me online or give me a call, and I'm happy to help.